this guy, Kirk Duplessis, he's very conservative with his spreads and stuff. He mostly sells. He's like a net seller of contracts. So, and he's not very directional. If he does go directional, he goes calendars, sometimes verticals, but very infrequently. But his comment on this was really, I thought, good. So when you're looking for a strategy to trade with spreads, it's really a process of elimination, not selection. You don't just go in and be like, I always love trading calendars. I'm trading calendars on this. So you kind of look at it and see what's going on with the stock and with the actual option chain. You guys know most of this stuff, so we can blast through it. But buy to open is a debit and sell to open is a credit. On any spread that you do, you're going to do both of these. You're going to buy to open one leg and sell to open another leg. And if you're screwing this up, as a beginner spread trader, you don't want to be selling credits. It's just, you run more risk and you got to be a little bit more particular about it. But it's like anything else. If you're paying money for it, you should be good to go. If the spreads are really jacked and you see like a negative number on like the ask side or the bid side and a positive number on the ask side, that's probably, you don't want to do that either, because the bid ask spread is just jacked, like you guys were saying about Roku today. So on a debit spread, you want to sell it to close it, and you should get a credit for that, just like any other position. The debit spreads are very similar to just running something naked. You're just hedging it, or you're making it cheaper to buy it, or whatever your purpose is for running a spread on it instead of running it naked. And if you did a credit spread, you're buying it to close it because you shorted it. Essentially, it's the same as shorting a stock. I might say front month and back month. You guys have probably heard that before, but the front month is the earlier expiration. The back month is the the further out expiration. You've probably heard these terms too. This is all the same crap. Like a long call spread is a bull call spread, is a vertical debit spread. Short call spread is a bear call spread. So you kind of intermix these terminologies. Margin versus cash account. So you guys know a lot of this stuff too, but margin you're subject to the PDT. But you have to be on margin to trade spreads unless you're trading naked puts, or you're doing covered calls where you already own 100 shares of the stock. So your position or your cash is covering the the risk of the trade. You can immediately utilize the capital after closing the trade. Round trips on spreads, this is something a lot of people don't know. If you open a spread, buy to open one contract, sell to open another contract at the exact same time, it's only one trade for a day trade. So you could open and close that the same day, and it's one round trip, even though you're buying and selling two different contracts. If you want to day trade on a margin account, you can open the long position. Like you see something, breaking the BB strat and you get long on it. And you don't have any day trades left, or you want to preserve the day trades, you can sell a call. Like, something moves up during the day, you can sell a call at the top of that, high a day. And then even if it drops down, you basically secured your profits by selling that call at the top. So it's kind of a way to day trade, even if you don't want to use day trades or you're out of day trades. And then that'll cover you against big hits overnight too, because you're short that leg. You can close it out the next day. So cash, you guys know, no PDT. You can trade cash secured puts and covered calls. Most brokers require 2K for trading spreads. Except Tastyworks. I don't know if Robinhood, anybody on Robinhood, I think they're under 2K. You can trade spreads.
If you're in here and on Robinhood, get out.
So trade settlement, you guys know this already too on cash accounts. Options you get it the next day. If you swing trade something, though, a lot of people don't know this. If you open it up, today before the close, you can close it the next day and you will immediately get that cash back to trade if you wanted to reutilize or enter another trade. And then you already know stocks take 2 days. So quick overview, long calls, long puts, you guys know that. You buy to open. The impact on your capital is it's a debit, and then you sell it to close. Max profit is indefinite. Initial loss, or the max loss is your initial debit. What helps the trade on any of these is fast movement in the direction of your trade and an IV increase. What hurts the trade is downward price movement, time, if it chops, you know that, and IV decrease. On a long spread, this is what you got to keep in mind. And no matter what kind of spread it is, if it's long, if you're taking it long, you're buying to open the better option. You're buying the more expensive option and you're selling the shittier option, right? So that's a debit. You're going to pay a debit for it. And like I said, if you see the ask side of it or the bid side of it is a negative number and the ask side is a positive number and it's huge gap between it, I mean, you shouldn't be trading that. The spreads are too big and it's just going to jack up your position more than likely. And that's what GameStop was doing. Like the bid ask was just jacked on a lot of these spreads, which is why a lot of the brokers, closed it down. And IV was so high, you were, potentially going to be failing no matter what. Um, the max profit on these is, asterisk next to this is limited by the short contract, but it just depends on how fast and how quickly it moves through the short contract strike price, and then how long it stays there or what it does after breaching the short contract strike price. Still, the max loss is the initial debit on these. What helps this trade is a steady or fast upward price movement and an IV increase, just like the long call, but steady and even sideways price movement, even if it just as long as it's slowly moving up, is fine for a long spread. Because you'll see in the next couple slides that it really eliminates theta crush. What hurts the trade is downward price movement, obviously, in longer times, like extremely long times, and larger IV decreases because you're buying to open a better contract and selling to open a cheaper contract. They offset, theta, and then they offset IV spikes between the two. But depends on how wide you create this spread. And we'll get into that. And the short spread is selling to open the better option and buying to open the crappier option. So you're selling somebody this option, figuring that it's going to move away from this strike price, or it's going to move sideways along. It's not going to breach the strike price. So that's a credit that you're going to receive and you're going to buy to close this. So you always have to have buying power. If you're going to get into trading credits, you have to have buying power reserved. You should only be trading like 50% of your account so that you can buy something that's going against you because you're going to pay more for it than you receive to open it. And your Mac,
Tinman,
yeah.
can I ask a question on the long spread, or do you want to?
No, go ahead.
Yeah. So on the IV decrease on the long spread,
Mhm.
you're buying a call and selling a call
Yeah.
of the same week contract.
hmm
So even if the IV decreases or increases, doesn't it cancel out?
It will pretty much. There's going to be like a small percentage point difference between the two contracts, and it really depends on how you structured it. If you're like in the money on the long and out of the money on the short, you might see a
Okay.
little bit of IV change because it just depends on how big the spread is. Or if you're doing a calendar spread, we'll talk about that. Like the front
Yeah.
expirations, the front months will really
Mhm.
see more volatility than the back months. So,
Okay. Thanks.
yeah. Um, so the short spread, like I said, you'll buy to close it. The max profit on this is your initial credit. So you'll see people like Kaizen will post these a lot and say, and I was posting these for SPY, like you can do same day credits on SPY, and all it's got to do is stay below. Like if you can call the high of day on SPY, you can sell credits against it and just sit there and let it deteriorate. Like just watch theta crush those spreads. But you have to buy to close it. So that's why you always want to have buying power left over if you're selling credits. But your max profit is that initial credit. And then the max loss is the difference between your strikes. But this is where the risk comes in and why you shouldn't trade these if you don't know what you're doing. Because if your short strike expires in the money and the long strike expires out of the money, you're hosed. You're having to buy all of those positions and sell them at that strike price. So don't mess with this stuff until you've got some time on with credits and whatnot, and you know what you're doing and how to adjust them. But for these, this is your neutral trade, neutral directional price movement toward, sideways, or away from your short strike helps this play. So you literally just have to pick a high or a low and sell those calls or puts against it. And IV decrease hurts this. So if you sell it when IV is low, and then say you come into earnings and you weren't tracking that, IV is going to crank up, and now the cost of these options they're more valuable, obviously, because IV went up. Um, so what hurts the trade is price movement past your short strike and IV increase. Any questions on that? Good to go. Here's your basic spread configs. So your vertical is you are at the exact same expiration date and you are selling different strikes. Buying a strike, if because we're going to only talk about debits from here on out unless you guys have credit questions. But you're going to buy the better lower strike on a call spread and sell a higher strike and vice versa on puts. calendar spread, you've seen this from Harry. He's phenomenal at calling these out. So you're buying the selling a shorter expiration date at the same strike and buying a further out expiration date at the same strike. And really, all you're playing with this is the value of the extrinsic value, and then some of the time decay. For a diagonal spread, you are doing both. You're kind of mixing the vertical spread. You're buying and selling different strikes, and you're buying and selling different expirations. And the diagonal spread is basically your building block for poor man's covered calls and synthetic covered calls. So we'll get into that a little bit too. General guidelines: the wider the strike spreads, the less protection and the more profit, because you're getting a higher net delta. So if you buy an at the money contract on Intel, it's a 50 delta, and you sell 4 strikes out, it's maybe a 20 delta, and your difference between the two is the 30 delta. So you're making a 30 delta off of that, but it's less of a hedge, right? You lose $1 on the trade. If the Intel goes down $1, you lose $30 on it because of how wide the spread is. It's more expensive to trade these, but more profitable. And then if you tighten up the spread and you're only doing like a $1 spread, then obviously your delta's getting chewed down to like, $2, $3, $4, $5 or something like that. For expirations, it's the same thing. The wider you do an expiration, say you buy, you sell next week's, 50 contract on Intel or whatever, and you buy 2 weeks out, that's a pretty tight spread and on the expirations, and it's good protection. But if you went like 2, 3, 4 months out, then you're only protecting your trade by that value of the short that you sold. So and when you're looking at all these spreads, sorry, on a lot of these tickers that we trade, you won't have any problems building these spreads because they're super liquid. Some of the stuff that I pick up on my scanner that I look to trade off of like big dips and stuff, um, they're harder to construct some of these spreads because they're less liquid on the weeklies. So you're kind of limited to just looking at monthlies on those. So we already talked about this. Vertical spread constructed by simultaneously buying and selling an option of the same type, like calls or puts, and expiration, but at different strike prices. So on Intel, I think Intel's like right at 60-ish. So buying a 60 and selling a 65. This is the most basic option strategy that serves as a building block for more complicated strategies. When you start hearing about iron condors and all that crap, that's all based off of a vertical spread. But those are credit spreads for the most part when you start hearing about a lot of the complicated strategies. So debit spreads are directional trades and credit spreads are neutral or directional. So basically, wherever your short strike is on these credits, you want it to stay above that if you're buying calls, and you want it to stay below that if you're selling puts or selling calls. So the benefits of good.
Kirk normally tries to capture all those IV crash credit spreads, right? I mean, he normally sees wherever the IV rank has gone above the particular level, and then he tries to bring buy spreads so that whenever the IV crashes, he can cash on those. Isn't
Yeah.
it?
Yep.
Yeah.
That's what a lot of people do. You can trade credit spreads around earnings, and just by looking at the IV, you can add that as a lower study. And a lot of them are 2 to 3 weeks out. IV is getting cranked because people are swing trading monthlies or whatever through that earnings, gambling monthlies through that earnings, and that's when you would want to look to sell credits on. Yeah, and then even if it just goes sideways through it, or even if it moves against your positions, the IV crush is usually significant enough that you're still making money off of those trades. um, so the benefits to this is on the debit spread, you're just basically, I mean, you're trading a bullish or a bearish position. You're just lowering the cost to trade the position while you're taking advantage of basically the full movement. It hedges your trade against large extended hours moves though. So like if, Roku dumps, $20 or $30 after hours, you can't do anything with your naked positions on that. You're just sitting and holding. On this type of play, your shorts are getting crushed along with your longs, and you're mitigating a lot of that loss. And then the credits, basically, you can sell credits against different tickers when there's sideways action, or if you're shorting IV, like we said with this. So for calendars, same thing. This is great. You really don't want to trade calendars on volatile tickers unless you have done some outstanding technical analysis and you really know where to select the strikes, because gamma is your biggest foe in trading calendar spreads. Gamma acceleration just crushes if you get the trade right on this, but you get the targets wrong, you can actually start either losing money on the trade or losing profit at least on the trade. So this is good for low to mid IV trades. Um, and the benefits of this is you've seen Harry's trades. You can put in very low dollars on these and realize 100, 200, 300% profits on these kind of trades. And then this is also a great trade for, you've probably heard people saying, oh, you want to be delta neutral on your portfolio if you're swinging stuff. This is a very delta neutral strategy because you're selling the exact same strikes. So the only risk that you have, like I said, is this gamma acceleration. If you get a fast, quick move through your strikes, gamma on the front month contracts will actually increase the value of it exponentially faster than the back months. So it just depends on how fast and how hard that move is. And then if it hits a resistance and traces back down through it, you're good to go. So for calendars, you really want to pick, you don't want to pick at the money. You don't want to trade at the money. And we'll get into this when we go over to the other, um, so, don't ever trade these. If don't trade these as credit trades as a novice spread trader, because you can really foul these up bad. Hold on.
Jason sucks.
You fucking suck.
Whoa, dude.
Oh, that's harsh. It's the drop off from from freaking
Oh, from the coffee?
coffee crash. All right, so what are we at here? So calendars are good. You've heard people say you want to be delta neutral. These are basically the same deltas, so that's a good deal. Like during these last couple days of sell off, calendars are great for this, and I'll show you this. This is amazing. It's like magic when you look at the profit charts on these. All right, and diagonals, I like these, but like I said, depending on what you're trading these on, they're hard to set up because you're buying and selling different strikes and different expirations. So on like really liquid tickers, hold on.
Chef, did you see Google?
All right, sorry.
Oh, I'll shut up.
So diagonals I really like because you can take advantage of the benefits of the vertical and the benefits of the calendar, and then you have less risk of gamma acceleration and like screwing yourself up by picking the right direction but picking the wrong strikes and stuff. This is still good for slower expected moves, like stuff that kind of just moves sideways and up, like just has a nice upward kind of trend. Gamma is still working against you, but the basic guideline for this is, and we'll show it on one of the later slides, is if your debit for this position is less than the width of your strikes, you should be pretty good to go for moves against your strike prices. And we'll talk about that a little bit more. But this is the basic setup for poor man's covered calls and synthetic covered calls. Again, anything that messes with expiration dates, do not sell them as credits unless you know what you're doing. So here's a vertical example of Neo, and it's probably, I don't know what it's been doing. I haven't looked at it, based out a little bit more. But last time, we do all of our technical analysis. We're looking at this, like last time it hit like a high and then retraced. It took 4 to 5 weeks to recover. So we're swinging options. We want to pick up an extra 1 to 2 weeks on that. So we're looking at 5 to 6 weeks out. swinging an at the money call, 57 delta, costs you $660, and you got $7 of theta decay every day. And obviously that's going to accelerate the closer you get to expiration. But if we get to 60, if we get back up here to the 60 price mark where we think we're going, return on your capital is 110 to 138% if it takes 3 weeks to get there. The loss on the capital, if it drops to 40, say it takes another leg down into this range where we think there are additional buyers in that zone, your loss on your capital is 50% to 80%, right? So if we swing a vertical spread on this and we do the same thing, we go at the money and then we sell. So we buy to open the 16 April 46 and we sell to open the 16 April 55. So we buy the better strike and we sell the crappier strike. And that's actually almost a $10 spread, right? So that's a pretty aggressive spread. Your net delta on that is 20. So, you're less than 50%, but your cost to trade this is also less than 50%. And your theta is actually very, very minorly positive. So you're actually eliminating theta with that. So return on capital at $60 within 3 weeks is 80 to 118%. So you can see how that's not bad for the comparison. And your loss on capital within 3 weeks, if it drops to 40, anywhere in that time frame is 42% to 60%. So you're actually saving quite a bit on this. And like we said before, the wider the strike and the wider the strike spread, the quicker the profit and loss, but the more expensive it is to trade. So the closer the strike spread, the slower the profit and loss, but the cheaper it is to trade. And you can go in the money, at the money, or out of the money on the long strike. But the closer you get to expiration and the further in the money the short strike is, the quicker your profit will be capped. So you kind of want to watch these as you get towards expiration. If your short strike is in the money, you're probably looking at wanting to take profit because that gamma acceleration will put both of your strikes, your long and your short, at like close to a $1 delta. So even if you got a $15 move on something after they're both in the money and close to expiration, they're just going to cancel each other out. Any questions on that? All right, cool. Vertical.
Yo, this is the part, guys.
This is the part. All right. Here's your naked call, okay? And here's your vertical spread. This is your theta crush. That's what you're looking at the whole time on theta on your naked call. And here's your theta crush on a spread. So damn near flat. And what you notice with this is as you get profits on these on your naked calls, you're kind of chasing theta. So even if you're getting profit up and you're moving sideways, your profit's staying the same in this range. So you can also look at this too and see up here in the corners, these are profit zones. You basically completely flipped the profit areas out, like your max profit areas. Here, obviously naked call, you need it to move up fast and hard. And over here, you don't care how fast and up it moves. You've got plenty of time on it. And actually, the slower it moves up, the better off you are on the profit. And then you look at the loss area, and it's just massive over here where you can really quickly lose a lot of the value of your contract. And over here, it's tightened into the corner. So if we look back at this chart, we're saying, okay, our profit target is up towards 60, but it could take a leg down if we took an aggressive entry and we go towards 40. And we'll look at a scenario if it takes a leg down and chops and then comes back up and starts working its way back up in this range. So, excuse me a second. Here's a scenario. It moves sideways a couple of days, drops back down, hits that range right around 41. We got buyers stepping in, they pick it up, moves sideways again a little bit, and then gets up above our strike, probably about $3 from our entry, right? You're at $11 profit on this at that point. On the vertical spread, you're at $91 profit. And then the difference in the drawdown is a good almost 15%, 14%, whatever. And then the profit difference, 1.6% and 31%. And your outlay on this is $660, and you just made 1.6% swinging it for 2 weeks. Here you made 31% off of $300, swinging it at the same time frame. And you can see too, we were just literally chasing the theta curve the whole time. You're getting a couple bucks movement up. So over here, you get above that theta and above your initial entry, and you're just starting to make profit. And you're getting into this darker green area up here. So if we look at the 100% plus profit zones, here's your 100% plus profit zone on the naked position, and here's your 100% plus profit zone on the vertical spread. 50%, 50%, right? Oops. So you can see here, you're chasing the 50% zone the whole time. It's stepping up. You need that big movement up into 50%. Here, you need to just keep going sideways and slowly moving up. And 50% will come to you, and 100% will come to you. And then these are all dollar amounts too, not the percentage amount loss. So the calendar example, same thing. We're looking at the same kind of scenario, all the same details, but here we're going to do buy to open the 16 April, 55, same strike as the vertical, but we're going to sell to open the 9 April. So we're selling an earlier expiration at the same strike. So if we hit 60 within 3 weeks, our return on capital is 20 to 55%. And if we drop to 40 within 3 weeks, our loss is anywhere from 28 to 33%. But also, your theta is basically neutral and your delta is basically neutral, $63. Okay. So the way that you build this, you want to sell at least 2 weeks out on your short leg, but ideally 3 weeks. 3 to 4 weeks is nice because your theta curve, as you can see on this last thing, I mean, this is 5 weeks out, so about 45 days. Your theta curve is almost a 45-degree angle on these. That's what you want to sell. You want to sell somebody this contract, right? Hold on a second. All right, so yeah, you want to sell somebody that 45-degree theta crush contract, and you want to buy the one that's a little bit flatter because of the time you've got on it. So yeah.
So could you tell us the criteria by which you're selling that 2 weeks out? I mean, what
Yep.
is the catch?
Yep.
Why you okay?
Yeah, so
Okay.
you want to basically be selling at your targets. You want to give it you can't, if you sell this at the money, you leave very little room for profit because of the gamma acceleration that's going to happen on this front contract. Okay, we'll show that in the next slide. But you want to look at this like, say $52 is my price target because I think it's going to come up to there and reject, right? That's a pretty decent technical analysis on that. You could go further up at like 55 right here at these dojis where we're going to see that consolidation. It's definitely going to reject when it hits that. So that's what we picked, 55s as our target, and we've got some time on it. And we really don't want to see that whole movement, but we don't want to see it blow through like a 50 if we sold a 50. We don't want to be too close to the money on the calendars. So does that make sense, Methan? That was your question?
Yeah.
Okay, cool. So that's all right. Next slide then. So here's the same thing we looked at. Here's your naked call if you're trading that. Here's your calendar. Look at this. Look at this theta. Sorry, theta timeline on this. It actually, we inverted it a little bit. We got a little bit of a cup and handle on this. So, and that's because your front month is getting crushed faster than your back month. Okay, but now this is what we were talking about. If you get a fast movement up, if they drop news, you're not making any money off this trade because it's going to blast up through. You make okay money on this up until you get to your short strike, and then it just flattens out. And then you actually lose money up here. So you can see that too, and you notice that up here in this top corner. If you start cranking on this up here, you're actually losing money. You want this to move slowly and steadily towards your profit target. Same scenario, right? We drop down, chop sideways, come up. You're at 46% profit on this in that scenario, and you only drew down about 20% on this. And you can see here, if it dropped to 42 and just moved sideways for 2-3 weeks, you're not losing any extra money on this. It's just staying sideways because that front month is getting crushed.
That's the reason that you always check how many weeks did it take to retrieve that level or get back to that level. So,
Absolutely.
All right. Now it makes sense. Yeah.
Yeah. And then we look at the profit zones, right? There's your 100% and 50% zone. So again, same thing. You're still moving. You have less of it over here because if it's moving up faster than what you had on the vertical, if it's moving up faster, that's not ideal because gamma accelerates on your front month quicker than on the back month. But you can see with that sideways movement, again, all you want to do is sit on this. And I did this as a longer time frame, trade, but you can do these a little bit shorter. And if it just moves sideways from here, doesn't do anything else, you can get into 100% profit on this trade. So if it moves up again a couple bucks or a dollar more, you're that much closer to 100%. And then here is probably like what, 70%, 80%. So you move sideways 2 days, 3 days, and you're in 70, 80% profit. And for calendar trades, like your usual target, what you'll see with Harry is 20%. So look at how large this 20% zone is for profit. Literally, if it just moves sideways from your entrance, you can get 20% off of this trade. And if you're taking home 20% off of every trade, I mean, that's massive.
And look,
So,
even if it goes down, even if the price goes down a little bit, you're still like not even
yeah,
that bad. Like even if it's under 46.50, like
yeah,
that later on, you're still positive in your trades. That's crazy.
absolutely. Yeah. Yeah. Yeah, all the way up until the end. What this doesn't show is what we'll talk about with the poor man's covered calls. This is only your short expiration right here. This is only to the 9th. If you get up into this area and you're below your short strike, you're below actually, it's both your strikes. That front month, you can make the decision at that point if you want to just uh, let it go and that front month will expire, and then you can run naked or convert it into a vertical spread at that point, right? Or roll, let it expire. You're sitting on it overnight, over a weekend naked. So, it could take a hit, but that's up to you for analysis to see what you want to do. If it's on a strong push, you could just let that front month expire worthless, and now you're in this naked position, and that will immediately add the value of your short to this profit. Right here, you're at $223 profit. That short drops off. You probably just added another $100 profit to this target because you realize the entire percent of that short. And then you're naked, and you can convert it. You could roll it out a couple weeks and convert it into a vertical if you wanted to. So if we look at the diagonals, all right, same scenario, but this time we're going to buy to open the 16 April 48. So we're buying this closer to the money because we're creating a diagonal, so that's fine. So we're, $2, $3 out of the money. And then we're selling to open the shorter expiration 50. So just a $2 spread on this, but we're also selling shorter. So this is more expensive to play. It's $153. But you have the benefit of this getting crushed faster, a little bit more because it's a different strike. It's a crappier strike than your long, and it's a shorter expiration. So return on capital, if we hit 60 within 3 weeks, 35% to 90%. And if we drop down, see this is where this really covers you well. It's only 10 to 28% drop down. Same thing with kind of building these out as the calendar. You want to ideally be selling the short leg 3 weeks out, and then your short strike price has to be out of the money, same as the calendar. And the higher the debit on this, the wider the spreads, the better off you are against gamma acceleration. So, like I said before, the other one with the verticals, you can be in the money, at the money, or out of the money, but the short strike should not be, but you should not be too far out of the money on this because then you just really limit your ability to sell against it to create that diagonal. So, and here's your chart on this, very similar to the calendar, but this is almost completely inverted theta curve on this. And you look at the same scenario, 14% drawdown, 87% profit, and $153 to trade this, right? There's your 100% plus zone and 50% plus zone, and then your 20% plus zone. So literally this very quickly within the first week, just moving sideways, you're at 20% plus on this trade. And I mean, even if it drops down from there, you're following the theta curve. So even if it starts dropping off, you're maintaining the same profit on this. And usually a target for diagonals is 30% plus, and you can see that's even closer than the 20% on the calendars. So kind of crazy. I mean, you could drop on this, what, $2, $3 from your entry, and then just move sideways, and you're going to be in the 30% profit zone. And again, here though, you see well, your max profit is like a sideways move right up to your short strike at 50. And then once you start going above that short strike, you start losing profit. You're not losing money, you're just losing profit. But that's what you have to keep in mind with these diagonals, because that's just gamma acceleration right there. So any questions or comments on that? Cool. All right. So that's pretty much it for the meat and potatoes. The summaries are here, like, we can answer questions if you want to, but the vertical is basically flattening out your theta curve, right? So you could buy these and just double your size on these if you wanted to, instead of trading naked positions, just to flatten the theta curve, and then you're going to realize the same profit or better off of these just by doing that, selling short a position. And it's going to counter IV also. Like I said, it flips the profit timeline around, so your profit is up here, and you're still making good profit if you crank up to this area, but you're making better profit as the front, or as the short decays, because it's further out of the money. And basically, the cons on this is it's going to cap some of your upside potential. If it blasts through your short strike, you're going to basically get to a flat curve. That's where you see some of those profit option charts, and it's going sideways after a certain point. The loss on this is a relatively linear loss. If you start coming down, it's still a linear loss on this. Basically you can see that pretty easily. If you're going for wide spreads to capitalize on better delta, then it can still be kind of pricey to trade these, but the benefit is just crushing theta. You're countering theta on these. Let's see. All right, we talked about all this stuff. So I guess I should have been clicking the whole time. So on this one, we're inversing the theta curve again, slightly. So you got that nice round bottom on it. Your targets are up here for profit. And like we said, even just moving sideways on this, and you can get into the 20% profit zone. This one, like I said, your risk, if you see on the left side here and up here in the corner and past the center of your short strike at 55, your risk, if you go past the short strike, is pretty quick acceleration of profit loss and decay. Diagonals, same thing, right? Pretty solid setup. I think, okay. Any questions on this? Because, we covered that pretty in depth on the other slides.
I'm
No,
fine.
I'm good. I'm good.
All right, cool. All right, so we'll go into poor man's covered calls, right? So we know, right, that the diagonal is basically your poor man's covered call, synthetic covered call. So if you guys, here's the scenario, right? Something takes a dump and it's a solid company, and you guys want to go long, like real long. So your options are buying leaps and holding, buying naked calls, and just playing the dip, or set up one of the strategies that we just covered with calendars or diagonals. So you can build a very deep and wide diagonal on it. Buy a really long out expiration, buy your leaps at the money or in the money is the best option in case it dips a little bit more, and then selling front month strikes at likely resistance points along the way. So you're doing your normal TA, you're swinging these leaps, but you're just basically selling short against the position, if for nothing else than to kill theta the whole time. So you let your front month expire worthless, but I don't often do this because there's the capital on the account, and tied up in that short trade. You can usually realize more profit off it by closing it a little bit early and then selling something else against it. So Intel case study, I'm in this trade right now, and this is the poor man's covered call, also known as the synthetic covered call.
These are cool.
Yeah. Yeah, we could do Apple. You'll see this is, this, you just paint this right across any ticker, and you'll be able to see how it relates. So Intel gapped up this morning, I think, on the 13th, and I think they announced that they were outsourcing their production or whatever. It was positive news, and it was coming into earnings, and everybody was, buying the hype. So got a big move up. And then on this doji candle on the day, it looked like it was catching good support. So I bought to open the 16 April 57.50. and that was, I think, right at the money at the time. It was about 400, and then sell to open the 29 January 61, and I was looking at the 61 based off of the resistance right in here, that from the bottom of a gap. Total debit for that trade about 300 bucks. Right now, coming into earnings, really bullish, and I was also looking at just the IV crushing this short front month, and you can look at this pretty easily. Like if we look at well, Workhorse is a shit example. So look at Intel, and that's not really going to tell you a whole lot. Because anybody know any tickers that have like earnings coming up?
I did like a week ago.
I don't know. You can kind of see it on this, but not really. This is a pretty even, IV
You're
curve
looking for
on
like the
this.
spike in it.
Yeah, you'll see like the front month is higher, and then
Mhm.
the back months kind of even out. Ulta,
Tesla's about a month out, right?
okay, Ulta. Yeah, 66%, 57%, but this front one that's not even gonna go through earnings is 35%. So you can see
Look at
here.
snow. Look
Well,
at snow. SNOW.
oh no,
SNOW.
that's
Next.
that's gonna be just ridiculous probably because it's
Cause
an
the snow.
IPO. Yeah, that's so they're. I guess if they're coming up on earnings, it could be, but you see it
Yeah.
But you're
here,
looking for a
right?
mountain. You're looking for a mountain and then like a
Yeah,
yeah.
and then it kind of tapers off.
Mhm.
So that's basically what you're looking at on some of these things. And Alto is showing that too. So you've got 35% on this one that's not going through earnings. You got 60-ish percent on these and then tapers out. So 40-ish percent is about normal. So 16% IV crush or 12% IV crush is massive on these things. So that's what I was looking at with this setup too, was selling this 61 call short because IV was cranked on it. And then we're going into earnings. And I'm just sitting on the April because it won't really realize any IV crush, maybe 2% or 3% or something like that. So obviously we can already see that it banged up, but it immediately sold off. And so I was in the money on this, and I'm not really concerned about it. I have a homework at the end of this that you guys can watch, 3 videos on getting exercised or assigned when you're in the money. Um, so I sat on it. I basically closed it out down here, and I closed it out for a $5 cost because it still had what, like I think a week and a half left on it. And in that time frame, I was expecting it to probably catch support off of this gap. And really, it was at like 95% profit or 90% profit or whatever. So just close it. No point in sitting on it, letting it bounce back up and chew away at that profit that you just realized. So I just made $100 off that trade, even though Intel dropped, whatever that was, $5 or $3 from my entry, basically. Um, and then I waited until it came back up here and tested a zone that was in this area. So you always want to basically be selling when it's testing a zone or when it's approaching a zone. You want to sell it into momentum. And I sold it into that wick up into that area. So that way it rejects right away and you start getting some immediate, crush on it, theta crush and the just the delta crush. So I sold a 12 February 59 call for $64, and the 59 was up here, and I probably had a zone drawn in off the top of this wick where it was a good rejection point. You can see it that played out too pretty well, where it kind of chopped against that for a while. So I bought to close that as it was coming up into here and tested this zone. I thought that it was going to probably break through and then it was going to be, going against me. So I closed that out, and that was literally, it moved up from where I sold it, whatever, $2. But Theta just crushed it the whole time. So this was literally $20 profit off of that for, what is that, like a 25, I don't know, whatever, 30% profit on that trade. And then you're just lowering your cost of ownership of this long position. So $280 now to own this call that's 2 months out. Then on the 11th, right as it tested this and pushed up, nice momentum up, sell to open. So I sold the 62.50 for 26 February, so the next week out, $55. And I'm looking at 62.50 is up here, basically at the top of the wick, right? Or actually, it's a little bit below that. So I figured it's going to bounce off that. There was a zone in there that I had marked off. And so that's what I was looking at as my target for a rejection. And then I bought it back over here as it dumped off of that rejection, came up, chopped quite a bit, let Theta kill it. and then bought it down here at the bottom of the 22nd. And that was another $22 profit. So another almost 50% profit off of this trade. And just lowering the cost to own this, quasi leap, just not really a leap. And then sold again as it pumped back up into here. And you can see I'm just selling further out of the money each time, just identifying the next zone where it's going to reject. And that was the top of this wick. And that correlates back further to something else too. So sold to 64.50, 5 March, 46 bucks. And then I closed that, just sideways movement. Really should have closed it down here. But I bought to close it for whatever that is, 60% profit, even though it just moved sideways off of that, because I sold it into that inflation. You guys have seen this with naked positions as you day trade. I mean, those positions, you can sell it into the momentum and actually realize profit, $4 or $5 ahead of it sometimes. So, so now that was the last trade. I'm just sitting on that 228, and I think it dropped down today. But each one of these, as you look at it, I mean, just really just adding to your profit the whole time. Now I'm up 120 on the trade, 30% credit, 36% credit, and 43% credit back on that trade, right? So regardless, even though Intel took a dip today, I think I'm still up like 20%ish on this initial trade, this contract, but I'm also up 170 on it. So not counting today because I didn't do the math on it. I did this slide yesterday. The leap alone was at 50% profit as of 2 March, as of yesterday. But with the synthetic covered calls, it's at 93% profit. So kind of crazy. So if you guys are not selling against your leaps, man, you need to open up a taste, even if you don't put 2K in it. Yeah, absolutely, chef. Sideways movement's great. Like these last 2 trades here, this was just purely sideways movements where I sold it here and then bought it over here, and it was still a profit even though it went up and came back down. Yeah, I'm also in this exact same setup on KO for a couple months now. So you can see, I mean, that's just profit. So right now I'm at 45 days left on this contract. I own it for a 43% basically discount. And this contract itself, even after the dip today, is still up 15%. So what I'll do, because you guys now know, because you're pros at this stuff, is I'm going to wait for it to push back up and get some gamma acceleration on it. It's not going to be as crazy because it's 45 days out, but gamma. It's going to be crazier than the July contract, which I'm going to roll this into. So I'll realize some gamma acceleration as it pumps back up into this level. Depending on what it does, I'll just wait for a good push up, get the gamma acceleration on the 45-day out contract, and roll that into a whatever it is, June or July. Let me see. Yeah, I'll roll it into June, get another 60 days out of the contract, and it'll be for free because I've got these credits here, and when that pushes back up a little bit again, we'll get some more profit on the contract because it's in the money pretty decent yet. So I think that's it. Managing these, basically the rules, I think I basically kind of covered that. So say this pumps up today and you sold a 63 instead of where I was at, the 64.50, you would want to, you're going to be looking at, how do I manage this if you're concerned about actually getting in the money on this and then chewing away at some of your profits. So the upward movement inflates the call premiums. So you always want to time your shorts as it's moving upward into a rejection area. And yeah, you could sell it and it might go into the money a little bit right away, like I did with that first trade going into earnings. It went into money like $2-3, but IV crushed it real quick and it sold back off, and it was a really profitable trade. It was almost 100% on that first short. So again, you're typically looking to sell 2 weeks out on these, so that way you can get a little bit more premium. But it's situationally dependent. I mean, if you're getting like a nice push into a rejection zone and you're confident about your TA and there's no news on it, like you don't want to be selling shorts into a rejection area if there's a catalyst. You're going to get smoked probably. So, basic, trading stuff that you guys already know. So if you're right here at this and you got that upward movement, 63, and you're concerned about it, you probably sold it for around 40, 50 bucks. So you're at a loss on the trade right now. So one of the ways you can manage this is to roll out and up. So you could sell this one, right? You could close this and sell this, and you're going to actually get about a $5 profit on this, $5 additional credit, but you're only buying yourself $1 of extra movement. But that is closer to that wick, right? So that might be closer to the um, that might be closer to a rejection, but you're also giving it more time to now go against you. So honestly, with this trade, I would just sit on it and see what happens, because if you look at this here, your delta is 48 and your theta is 10. So it's going to have to, remember that chart that we looked at, that theta curve. It's going to have to continue to keep moving up hard against that theta curve to actually stay in the money and actually stay profitable. So this is just going to deteriorate pretty quickly. So the next day we had a drawdown off of that zone, and you can see delta dropped 35, theta is 10. It literally crushed that contract in half by like 50%. So rolling up and out, wouldn't have been the best move. Right now, you could potentially just close it for no loss, but even today it dropped down into here, so this contract is worthless. So that was a winning trade if you just sit on it. Theta is your friend when you're short. So, um, so if you're sitting on leaps, right? You guys have to at least be, I mean, honestly, just trading just to kill theta on those things, and it will hedge against your any drawdowns or whatever. So yeah, and what Jason said, I mean, KO, you can run iron condors on that like until
Isn't that weird he
till
said
the end of
that?
time. What's that?
Isn't that weird that he said that? That's literally what we were saying the other day too.
Yeah, yeah. Uh, so let's see here where we're at. Yeah, theta. So I mean, you look at this. Say you bought like Intel, way out here contract, and you're in the money at like the 57.50 or the 60. Your theta is not much on it, but when you look at that comparison to you're going to hold this, so you got 227 days. That's $227 that it's going to lose, and that's just if it stayed the same theta, right? Obviously, when you get closer up in here, your theta is looking like this, $5 a day with 10 days left. So your extrinsic value on this, which you can add as a field on any of your brokerage platforms, it's right here, extrinsic value, $575 of extrinsic value on this $800 contract. So that's literally what you are going to bleed out of this contract as time goes by. So you need to earn that money back. You need to sell short against it to chew down this extrinsic value. And if nothing else, you need to sell against it to kill theta. And then also offset potential IV crush and whatever. Like we were talking about workhorse. Workhorse IV now is back down to I think like 150-ish or something from 200. And so I would consider picking it up now more than I would have when it was at 200. But um, this is simple. I mean, sell sell a way out of the money contract on it every 2 weeks. You can see the delta is 8. You're getting about 11 bucks on this, and that's going to offset 11 days of your theta crush and get you 11 bucks of the 575 back on your extrinsic value. And then really easy to set these up. This is what Harland looks at a lot for his midpoint plays. This is the expected move on this contract, on the 2-week contract. So $3 plus or minus. So we're at 62 at the time I took this. I think we're now at like 61 today. So max move on this at the day that I screenshot this was $3. So $65. And this is the market makers planning this, right? They're in this to win. This number is slightly inflated. It almost never hits these numbers unless there's a catalyst. So $2.78 move. So it's probably more like 250. And you just look at that. You can come out here $3 off of 61, 64. You could probably pretty safely sell this and be fine. But you want to be real safe because you want to sit on your leaps because you got them for 2, 3 years out. Sell these garbage contracts. People want to day trade them. So write a contract and let them day trade them. And then you just bank, $12 off of it for it's free lunch money. And that's pretty much it. You guys got any questions on that? Any nerd questions?
That That's really easy to do. You're just selling calls against
Yeah,
it and writing your leap.
absolutely. If you got leaps, even if you don't want to put 2K in an account to like hold the leaps, because they won't count your leaps towards the marginable amount. Open up a Tastyworks account. Just transfer your leaps over. It will take like 5 days. Just let the leaps sit in there, and then sell calls against them.
I got a better idea. How about you just slide me your username and password in my DM, and I don't have to open up Tastyworks.
Yeah, let me practice with your account.
Let me take a little test run on your account, Tinman. Then I'll consider opening mine up.
Sounds good. Yep, yep.
Cool.
Yeah. I mean, that's not complicated. There's like if you watch Tastyworks, and their platform's pretty decent too. They've got all their traders on there, and they'll actually post trades like throughout the day. You just hear them bleep 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 popping up, and they trade earnings a lot. And that's all they'll do. They'll sell these
Ooh,
like
earnings.
sell
Yeah.
8 delta contracts.
So you don't trade naked options anymore at all, right, Tinman?
I still scalp them. Like today, I took SPY for like 25% scalps, but
Okay.
I'm not swinging anything naked.
So
Now,
just
I mean,
quick in and out.
yeah, we could do like another session on legging in and out of trades because I do that. I mean, it's basically what I just covered with the poor man's cover call.
Mhm.
That's what would be. Let me go back to it. That's what would be legging in and out. Because you're literally like buying and selling and buying and selling, and you can do that like with I did Palantir, bought them last week, like right when Kathy Wood bought it, and it's dumped down, but I did a spread on it, so I basically closed the shorts, and it's kind of chopping a little bit, and I'm gonna wait for a little push up. Well, actually, I sold now just a day or two ago. I sold against it just to further cut the losses on it, right? So I still like it. It's still in a good range. It got IV crushed a little bit, and that's why I closed the shorts off the IV crush, and then I sold long against it, like basically set it up as a calendar now. So it's still a good trade, and you can leg in and out of these things. But I don't trade anything now less than like 45 days out. I'm always buying 45-day plus spreads at a minimum, and then I'm doing this. I'm going back to geez, I can't even scroll through these slides right. I'm going back to at a minimum always this kind of setup
Hell yeah, we're
on
at the beach now. Aw.
Oh yeah.
that's the kind of trade I always want to take. And if I want to just get more profit out of it, that's a minimum of what I want to take. I want to always do this vertical, and then I'll just take 2 or 3 of them, and then you're going to get the same profit as you get on a naked call. You're just not getting crushed by theta.
Word.
So, and then like if it dips down into here and you see it like all-time crazy support catching like a 4 hour or like weekly zone or something down here, just cut your you can close your short legs for profit like I've been doing with the poor man's cover calls, and then just let it run up naked or let it run a little bit. You always want to sell into momentum, right? And then let it run a little and sell a call back in this area and sell it wider or something. And you can do really well with them. Just the biggest things is with calendars, you gotta set your strikes right so that it's not going to blow through it. And if there's a catalyst play that pumps it up, I mean, you guys know, depending on how strong it is, it might retrace, it might not. If you think it'll retrace, just sit on it. If it's just pumping like mad, then you're going to be losing profit. I've actually done a trade that was like perfect, and I did a calendar, and it won't show it on this, but I actually lost money like the very next day it pumped up, and it pumped up so fast that I think I was down. It wasn't much because these are cheap plays, right? It was probably a $40 trade, and I was probably down like, I don't know if I had like 4 of them or something. I was down like $15 across like 4 trades or something. So you can actually lose money if it pumps up through your short strike too fast. So
I like the comparisons you did with the heat charts on the when you showed like the left and right one, and you were showing on the left like this is a not as good spread, and then here's the right one with a better spread, and then it showed you like this is how much loss you would actually be taking in your worst case, and even then it wasn't even
yeah,
that bad.
yeah.
So that's a really
Which one?
good
Oh,
comparison. I don't even know. It might have been a
yeah,
naked
yeah,
option against a spread for all I knew. I just
yeah,
remember
yeah.
watching that one. It was like Oh no, it was spread versus spread. That's right. You broke it down.
Yeah, it was one of these. It was
Cover
just the
call.
naked.
Or no, it wasn't a covered call.
No, it was this.
The vertical. There you go.
Naked versus vertical. And I mean, yeah,
That like that right there. That instantly shows you the difference between not as protected options and then protected options. And look, like he spent 660 on the left one, only 300 on the right one. Or
yep,
whatever. Get two of the right one then.
yeah.
If
Get
you
two of
if
them.
you want to. And like he's
Yeah,
saying, like you can leg in and out. What he means by that is you can exit and enter any kind of spread and reposition your spread however you want. As long as it's open.
yeah. If you look at this, the profit on this, right? Within 3 weeks, if you're 80 to 118% profit, you're not much different from the naked position. So you buy two of these, you're still less than
Yeah,
you're
the
still
risk
less than
reward is
100%.
way better on that bottom one. And look at your
Yeah.
theta. Like it's like not even
Yep.
you're
Yeah.
not even gambling at that point. I mean not gambling,
Yeah.
but it's a better plan at that point.
It's a better play. Yeah. I mean, it's just you're just hedged, and you can set these up as aggressive as you want. But that's the real thing right there. You're chasing theta the whole time with a naked swing. Um, what Chef asked about an iron condor, you're basically like, I don't know.
I like the net idea. I always tell people just because it's like
Yeah, I sent this actually, DM this. Jason and I were talking all big brain nerd shit about it a while back. I was running a Home Depot iron condor.
how'd
So
that go?
somewhere it went solid. It played out
That's
well.
another good one that sits in ranges.
Yeah. This is it. Um, oh, I'll just bring this down. Wait a minute here. Open the original. So yeah, this is Home Depot, just chopping in this giant range, 290 to 260 across. Like this is a daily chart, and so this was coming up into, I think it was right here. Yeah, it was in this range right here, and I was, or no, it was this one coming up nicely, and I just figured it was going to reject a little bit, and then just keep on kind of grinding against this, putting in a little triangle up against that, and then pushing up. So I set up an iron condor. I sold where this gold line is. I sold calls. So I sold the 290, or no, I was bullish on this. So I went a little further out. I think I sold the 295 and bought the 300.
So you're
And then
buying and selling a call and buying and selling a put.
yep. But then this is exactly what I was saying is to get the credit on it, you're selling the better contract to somebody and buying the shittier one. Just basically, I mean, you can do these naked, but then you have unlimited risk on each side, and you need a lot of
You
capital to
shouldn't
do it.
really do it
Yeah,
naked
you shouldn't do
because
it. And
prices
really,
right.
yeah, you could sell. So I sold the 295, bought the 300, and I think it was, I don't know, it was like 120, $150 credit or something like that. And you always want to sell it 45 days out because then you get this theta crush on the short contract you sold to somebody. And then I bought I think I bought this pretty close to the money. I think I bought the 265 and sold the 260, or sold the 265 and bought the 260. And so then it just went and chopped. Let me see here. I don't know. I don't know how to pull this up. Essentially, you just want it to go sideways in that range. And what happens is if it tests your any of your shorts, then you roll them, or you roll the other side up. Oops. Yeah, here we go. Yes, there's Home Depot. I think I was, yep, right here. Yeah, so you can see I sold the iron condors up here, gave it more room to the top side because this was during the um this was during they were hyping it a lot with COVID, Home Depot's doing great with COVID and whatever. So I sold right in here. I sold this 295-ish, actually. Sold 295, right, and then bought the 300, and then I sold down below it. I was more aggressive with this. I think I sold right in here at the 260, and then I bought the 255, right? So you can see it was in the money for a little bit and tested it, but immediately after I sold it, some kind of news came out and it started dropping down. So when it started dropping down, I think like right in here, I closed this position up here. I closed that for 100% profit. And then the way that you manage these is you sell a more aggressive strike. So I sold a 290, right? And I think I got another $120 credit for that. And really, you want to sell that as it's coming up. But if you don't, it's moving down. You're just losing money on this top side trade the whole time. So that's how you manage iron condors. You don't touch the tested side. You move down the short side on the untested. So then that went down into like whatever. It went down into like this range in here, I think. And then I just was like, the heck with it. I'm now cashing that one out for 100%. And then I sold the 285. So now this is a $15 wide spread, which sucks. So that's holding a lot of capital in your account to keep that spread open. So when it dropped down into this range down in here, I happily closed that and took, I think, another 100% profit on it. So I was at like 120 bucks profit, 100 bucks profit, like 90 bucks profit. So I was at like 400 profit off this top side. And I just left that sit there because there's no point in closing it. This is worth like $5 at this point, or maybe 30 bucks or whatever. And then it tested that, came up, and I just let this sit here, just let theta kill it, and it just kind of came back, tested it again, pushed up, and then I think somewhere in here I closed it. And then I think I got like maybe 50%, 80% profit on this one. So that whole trade was, maybe about $500-600 profit per iron condor. But yeah, they can be stressful because if it blows through that, that's why you have to have that extra capital in your account, because you've got to buy this back. You got to buy this at a loss. So if you got like $100, I think I got about $100 credit for both of those.
What
Something
happens
like
if I
that.
don't want to buy it?
Then you're gonna get a sign, boy.
You're gonna have a bunch of dudes in suits show up to your door.
What if I don't open?
You better have a lot of guns. Actually, they'll probably just come take your car and shit. And they don't worry
Yeah,
about
they'll
that.
just dip out of your bank account without ever actually seeing you or like anything
They'll
in
just
person.
lock you out of your money.
Mm.
Yeah, Tinman, you don't want to pay
Yep.
us? All right, we got your password, bud.
Yep. Yeah. But yeah, KO is like, all that does is go sideways, man. Especially after friggin' Corona. I mean, it's done nothing but chop. It's been a massive disappointment. I think I bought it down in here somewhere, and I've just been selling against it. But initially, when I set up the trade, I think it was only like a $13 max loss on it. And so then I closed that for profit, sold again, and I was already, even no matter, by the second synthetic cover call sell, I was already, the worst case scenario for this, I think it was like $15 profit per spread, even if it went to like bankrupt. So yeah, I don't know. Yeah, I mean, this thing just, it looks like it's all over the place, but this range is like nothing. I mean, look at this. This is friggin' $10 range on this. The problem with this is there's no IV on it, so it's very cheap positions, which is good or bad. I mean, if you want to run it as a synthetic cover call, it's not that great because it just doesn't move. So what's this? This is coronavirus, and then it's just chopped in this freaking $2 range the whole time since then. So, anyways, that's it, guys.
Hey man, that was awesome. I recorded that whole thing for
Cool.
Navi, any parts Harlan missed, and other people as well.